Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Mark Marex, Senior Director of Index Research and Development with Nasdaq Investment Intelligence, Brandon Knott, Thematic Specialty Strategist at Invesco, Rhett Drugge, medical doctor, and he is also with Melanoscan, as well as Peter Doyle, co-founder and managing director at Horizon Kinetics. We're here to discuss the growing trends that are emerging in biotech and AI's impact on biopharma. Gentlemen, it's great to have you with us. Welcome to Trade Talks. And we have a lot to unpack here as we think about the trends that are impacting such a key industry. So, Brandon, what are some of the trends that you hear emerging from investors?
Sure. So I cover all thematic ETFs, and the most popular theme right now coming up, in addition to AI, is going to be biotech. And I think a lot of that's been brought by the trends in diabetes, so treating diabetes, obesity, two of the greatest problems ailing Americans and other developed countries. And but beyond that, we are starting to see that theme broaden out quite a bit. So going to CRISPR technology, we talked a little bit before the call about this, and genomics, the study of the human genome, antibiotic resistance. All of these are some incredible trends that are coming out of the biotech space that have been kind of pushing investors and financial advisors to give us a call.
Yeah, and Mark, what is your team's recent research? What are they showing?
Yeah, I mean, I'll add some high-level comments to that. I generally agree. Nasdaq Biotech Index has been preeminent benchmark, we think, for the industry. It's been live since 1993. Nasdaq, historically has like a 98% win rate of biotech listings in the US and globally. So it's a great index, I think, to look at, the underlying activity of what's happening in terms of, IPOs, which are still relatively weak, but getting a little bit stronger, a little bit more signs of life to them this year. M&A has picked up as well, and we think that, part of that is because there is this kind of looming patent cliff coming by 2030, where there's around, 200 patents expiring in the biotech space. That some of these larger biotechs need to find a replacement for. They need to find a way to replace that lost revenue when those patents expire. And part of the way is to look at sort of later stage, smaller cap biotech as potential acquisition targets. So that's something that we've been noticing that's more favorable. It's been a tough time for biotech since the go-go years of 2020 and 21 with Moderna and others doing really well. It's been a painful bear market, but we are seeing it kind of turn around this year a little bit.
Right, and of course, Dr. Drugge, a big part of it too is discussing how AI is enabling the growth and for trends to emerge in biotech as well. Tell us about Melanoscan. Tell us about the product, and then tell us how you're incorporating AI in your research.
Exactly. We are very bullish on what's happened with the Android system, and the whole platform allows us to move very quickly with different generations of systems that are very handy, can be used in whole body scanning, can be used directly into the consumer in the application. They can self-image, we can image them in the clinic, and we can run our models on them. We've been able to dramatically reduce the melanoma detection in sensitivity. So we're now detecting things at 1/4 of the area we used to be able to find them. We've dropped the biopsy rates, so we're much more specific and sensitive, from 30 to 1 to now 2 to 1. And it's really been a miraculous clinical event to see this unfold right underfoot. We dropped our melanoma detection rate, or we increased it from 3.5 to 7.5 detections per 1,000 visits, which is almost 1 out of 100 visits, which is almost amazing, and it speaks to the incredible insensitivity that doctors have had towards these subtle little cancers, an average of 12 years before they're detected. So we're going to break that down, decrease the costs of healthcare delivery, and save real lives.
Yeah, and Peter, you're investing in AI through CRISPR technologies.
That is correct. And we're trying not necessarily the companies that are developing the technologies, but the companies that benefit from the technologies. And we find that to be much more satisfactory. So within the biotech and pharmaceutical industry, these companies that develop the drugs frequently have a patent for multiple years. They have the ability to basically see other uses for those drugs. That gives them time, it gives them optionality. So that's how we're playing it through our funds.
Yeah, and it sounds as if leveraging this type of technology, not only can it be more cost efficient for the industry, but for early detection, preventative care, better cost savings for the average person as well.
Yeah, I think we're hitting a cost cliff in healthcare where we can't imagine, with the aging baby boomer population and the escalating cost of care, how rapidly we might deflate that market and kind of bring things to home in a safe, secure way through your cell phone technology, looking at the most powerful part of your cell phone, which is your camera and your video camera. I think that translating that knowledge into something that's fungible for everyday self-care can be done privately, securely, and with our APIs, we should be able to deliver to the market.
Yeah, I mean, it just, from the consumer perspective, it seems like it makes a lot of sense to me. It saves time from going to the doctor so many times for so many different kinds of scans. But early detection, that's all we hear about is preventative care and early detection. It just seems like it's a natural fit. So let's get back into the product for a moment here, Brandon and Mark. What does the competitive landscape look for, like in an ITF like IBBQ as an example?
Yeah, so I mean, IBBQ tracks Nasdaq Biotech Index. What we see in the market is there are sort of a number of products out there, sort of broad, passively managed biotech exposure that give you fairly similar returns, similar performance and behavior, but there are some outliers there, and it might surprise folks to know that something like the XBI, the big spider biotech ETF that tracks an S&P biotech index, talking a fund of $7 billion in AUM, tracks an index that's very different from ours. So ours is a market cap weighted index with some caps. That means, generally speaking, the bigger the company, the more established you are, the bigger your weight is going to be, approaching about 8% for some of the biggest ones like Illumina, Regeneron, Amgen, the champions, right, that have emerged over the last couple decades. The S&P index is a equal weighted index that disproportionately weights the small cap names, and there's a long tail of unprofitable, low quality biotech names that are small cap. And so you almost have this kind of mirror exposure where most of it is large cap in our index, most of it is small cap on S&Ps, and you get massive performance differentials on the order of more than 20% outperformance for our index the last 3 years.
Yeah, and of course you want to factor in cost as well.
Right. Yeah, absolutely. So I was going to say, despite despite what Mark's mentioning of there being some differentiators, we do find that we have pretty heavy overlap with both competitors that Mark mentioned, IBB and XBI, and around 85%. And we do that at about half the cost. So we're about 19 basis points from an expense standpoint versus our competitors that are 38 plus. So when you get very similar exposure and as Mark mentioned, we're getting better performance. If you look at IBB outperforming on the year to date, 1, 2, and 3, so basically since inception with our strategy, and versus XBI, the equal weight counterpart, outperforming on the 1 and 3 year. And to Mark's point, something that could continue.
Yeah, and Peter, tell us about how you're managing portfolio risk and your fundamental process there.
Yeah, so the future is obviously unknown, and so we'll take more established companies, and that will be a big chunk of the fund. Then we'll have medium tier companies, and then the smaller companies that we think have great pharmaceutical growth potential. And we'll do it that way. So it's more of a shotgun approach. We're not trying to make a big bet on any particular company, but our real strength is basically a buy and hold strategy. We get the time that companies need to develop and grow into their best self. And by doing that, our returns over a long period of time are actually quite good. So the way the tax law is structured is that buy and hold is a much better strategy. And if you find something good, the best thing that you can do for yourself and for your investors is to leave it alone and let it compound for you over many, many years.
Right. I mean, and of course that takes enormous skill to do, so that's when you have that conversation of passive versus active as well.
Right, absolutely, yeah. So in our space, that's typically what the argument is. So when we talk to investors, they're trying to figure out, do they go with a passive strategy, an active strategy, do they equal weight, market cap weight? And I think you first have to know the space, and it's a space that has a ton of small caps in it. It can be difficult, industry to industry to know all the science behind it. So to pick, a handful of stocks yourself can be a really difficult undertaking. So I say, like, you either go with a really strong active manager who's very focused in a specific segment of the biotech industry, or you take the approach that IBBQ takes, and that's just kind of broadly diversifying across all the biotech names listed on the Nasdaq. And you know, as Mark mentioned, just market cap weighting and then capping the top 5 holdings at 8% and the remaining at 4%.
Yeah. I mean, particularly in the biotech space, Mark, to your point. I mean, there's a very long tail with the small caps, as you said.
Right.
Yeah, I mean, I think there's something like 600 or 700 Nasdaq listed small biotech companies in total in 2020, 2021. We had over 100 adds to the index each of those years that the index reconstituted, right? Capital was pretty much free in the era of COVID in those initial 1 or 2 years. Then, of course, rates got jacked up substantially because, you know, inflation was at historic highs. That dramatically changes the calculus on investing in small cap biotech that are either pre-profit or in some cases pre-revenue. It's a very different business model from most other sectors of the equity markets, and I think again speaks to kind of understanding the space that you're in. If you are going for a passive approach, you have to ask yourself, why do I overweight small cap unprofitable biotechs, where if you look at the trends in profitability over the last 10, 15 years, they used to be kind of on par with the larger cap names. Nowadays, they're losing about $2 for every dollar of revenue that they make. They're negative 100% in terms of their operating margins last year. So it's just a major, major difference that's developed over the last decade and a half. Way more small caps out there, way lower quality. The higher rates just make it that much less compelling of a space to play in.
Let's go back to the technology and medicine for a moment here. Rhett, it sounds like this could be used for multiple uses outside of dermatology as well. I mean, I'm thinking cardiovascular, MRIs, other types of scans as well.
Yeah, I mean, I think that the data sets that we're getting from small little devices like our Oura Rings or our Apple Watches are a tiny little fraction of what we can glean from the imagery, because most of the signs of disease that doctors have managed for years and years are visual inspectable processes. Right. You know, so that I think that we're looking at large cap companies like Google and the impact of NVIDIA and kind of remodeling and taking the physics of imagery and decomposing it into a biology framework is really the big opportunity on the table right now. And how they're going to do that and how they're going to act on that is just going to be explosive and going to collapse a lot of other activities and meld them into a kind of a more easily engineered healthcare product. And I'm fascinated to see how we do patenting and we kind of learn new things using large language models as their context windows are exploding into larger and larger, you know, million tokens, 10 million tokens. You know, how do we manage our brains, our newfound brains as investors? I think it's a really exciting problem ahead of us.
What about privacy and security considerations?
I think everything's going to happen on your phone. I think that the process will be on your private device, and I think that people will only accept models that are going to be really good for them in terms of their integrity. That's why I like Apple and the way they've moved to Apple Intelligence. You know, they've thought about it in terms of, you know, let's go privately. Let's not be the first ones to kind of air your dirty laundry. Let's be the ones who do it right.
Yeah, that's an interesting point. I think that's an interesting point that you bring up here. And Peter, my question to you is, are we still in the hype cycle of AI? I feel like a lot of companies, not even just what you would think of like an Apple or a Google, but you know, virtually every sector, they've rushed to get some sort of AI product to market, and we're starting to see some, you know, inconsistencies there.
Yeah, I think the marketplace tends to overestimate the short term and underestimates the long term. So I think we probably are in the hype, and some of the valuations for a lot of the stocks are very stretched, and it's hard to see how they're going to grow into them, even under the most rosy scenarios. But longer term, there's going to be real developments and real progress made on behalf. I wanted to get back to an earlier point about like companies that are beholden to the capital markets for funding. And that's something that you want to basically avoid. You don't want to basically make sure that the rosy optimistic market is available at all times, because it's not going to be. You want companies that are profitable today that can self-fund and weather the storms and can do their research, good times, bad times.
Yeah, and Mark, you've brought this up a number of times, you know, especially within the small cap space that really do have that exposure to a higher interest rate environment, just because you get a basis you know, you get a rate cut or two, is that really going to move the needle? Or if they're fundamentally sound, I think that's more important than just relying on what's happening with the interest rate policy.
Yeah, I mean, I think fundamentals are most important at the end of the day, right? We were talking about this last week, right? Talking about 25 or 50 basis points, is that going to change the story? If your capital structure is taking out floating debt, right, like now versus 3 years ago, whether you're 4 or 5 percentage points higher, doesn't make that much of a difference. It's still eating into your earnings a ton. And that's a big reason why, you know, large cap has outperformed the last few years, whether it's tech, whether it's healthcare, biotech. It's because a lot of those companies are on a, you know, fixed rate for now at least. They don't have to quite refinance yet. As soon as rates go really high and they have the ability to weather those tougher times with their big cash piles. You just don't see that level of quality in the small cap space in the US. By the way, it's not just a biotech issue.
Right.
Generally speaking, across small caps in the US, people have studied this recently and said, look, there's fewer companies than there used to be, and there's a lot of private equity acquisitions that have happened that if you think about it, who were private equity investors going to go after first? The higher quality stuff. They're going to take that out, and the lower quality stuff kind of gets left behind. And I think that's why you're seeing stuff like the Russell 2 and that S&P biotech index that overweights the small caps underperform the larger cap stuff.
I mean, that's a great point that you bring up in terms of who would private equity want, you know, who want to go for. And I've never thought about it in that context. But Brendan, I'm sure you see that in your work as well. You know, fundamentals do trump what's happening in the macro environment with companies that are under a microscope, if you will, such as biotechs.
Absolutely, and that's really, to Mark's point, that's really why I like sort of the modified market cap weighted approach, giving some favor to those larger cap biopharmas, which have really matured. And I mean, if you look 10 years back, really all you had was a bunch of small caps that were sort of had binary outcomes. They either, you know, they had one, maybe two drugs, and if they made it, they made it. If they didn't, the business failed. Now you've got these mature companies where they have already a nice profit center, drugs earning revenue. They've also are the main ones to benefit from M&A activity. They have the assets to do that. And you know, I think to me, those higher quality balance sheets, to your point, I think, is nice to have for more of an all-weather approach.
Well, I mean, Peter, especially too, if you only have one or two breakthrough drugs, once they come off patent, what happens to your business?
Yeah, exactly.
Right.
If profitability goes down, and if you're not developing something else, you're running out of optionality. So 100%, you need to be self-funded. You want to basically make sure under bad circumstances you're going to be able to continue your business, and that's, you know, staying alive is part of winning the game.
Yeah, I mean, right, it's not cheap either for R&D. I mean, these technologies are just so mind-blowing because of the research and the time and the technology that goes into it, and the great skill sets.
Yeah, it's, you know, but it's the great databases, the great funds of knowledge that are going to empower us to like kind of win the future. So we're feeling at Melanoscan that like having 25 years of whole body scanning and just the myriad diseases that people bear are going to just, do you have diabetes? Can we have a visual test for that? Do you have asthma? There's a visual test for that. So all these things that we think of as the inspectable self, going to the doctor's office, et cetera, are going to be something that somebody visualizes. You know, my great uncle worked in the Manhattan Project, and he was an oncologist, and he would always tell my mother, I can see what's wrong with that guy walking down the street. I know what this man's going to die of. I know what that woman's suffering from. He could see these things because he was so experienced. I think AI is going to play that role for us. And I think that we're going to be in a very different dynamic. And I think that the R&D expense is going to be about getting those great data sets and doing those trainings of very specific items so that we can just help to ameliorate these myriad problems that beset us as people. We don't explain how complex we are to any doctor. We do not tell people all of our problems, right. But they're there. And we suffer them, and we suffer them as families, as individuals, as societies. And I think that it's time for us to take the secrets, get rid of those secrets, and to kind of explore our own personal knowledge that is going to be accumulated on our cell phones. And that's why we're really bullish about using Android as a platform, because that's what 90% of the world's on, and just sharing the knowledge and having kind of a healthcare invasion rather than a military invasion of the world. Let's get together and kind of use our data sets to crush the problems of the world and make the world a better place. And I think we're going to see that.
All right, and we will leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.